As I record this video for you right now, there's 5 bank companies where their shares have been halted on the stock market because they are failing. In fact, one is the second biggest bank failure in US history, and it's all happening right now today, March 10th, not in 1929, but in 2023. Stick around, I'll tell you what it means for your retirement portfolio and your income. As we talk right now, or as I record this with you right now on market hours, during market hours on Friday, March 10th, the second biggest US bank failure ever is happening. It's Silicon Valley Bank. It is either the 15th or 16th largest bank in the United States, depending on how you measure what biggest means. But whatever way you measure it, it is one of the biggest 16 biggest banks in the United States, and it has just failed. There's literally a run on the bank, and the Federal Deposit Insurance Company, FDIC, has had to step in. Basically, regulators have had to step in and take over the bank. On top of that, there are other bank shares that have halted trading, right? So the stock exchange has halted other shares trading across other banks that possibly have a bit of a contagion happening. So what I want to do is show you some price charts, talk about what is happening and what it means for the market. So with that, let me come over and start with this price chart right here, which is a regional banking ETF. Now that horizontal line shows you the pre-COVID high. And obviously your brain can see that the price is now below pre-COVID high. So that is a sign of instability. These are regional banks, not necessarily the big 5. This is not JP Morgan or Citigroup or Bank of America, but these are still very big banks. As I mentioned, Silicon Valley Bank is now insolvent, and the regulators have had to step in. That's the 15th or 16th largest bank in the US, and this will be the second biggest bank failure in US history happening right now. So the regional bank ETF is absolutely showing that this is just not a Silicon Valley Bank. Now, here's the price chart of Silicon Valley Bank here. Now, this does not include March 10th, which is Friday, because shares were never allowed to trade today for Silicon Valley Bank. But even yesterday, they were down 60%. And in aftermarket hours, they were down another 60%. And regulators, like I said, regulators have stepped in now to start managing assets. A couple things about Silicon Valley Bank. Only 2.7% of the depositors have $250,000 or less of deposits. The reason why 250 is important is because the FDIC, Federal Deposit Insurance Corporation, they only protect people up to that 250. Now there's some nuances, it can go higher than that, but generally speaking, 250 is the number. Only 2.7% of depositors have 250 or below. That basically means 97.3% of all those depositors are above where the FDIC protects them. So not good. Now there's other bank shares that are also down and have stopped trading or have halted trading. First Republic Bank of San Francisco has halted their trading, so you cannot trade this stock right now. Before it was halted, it was down 22% just today. Then you have Western Alliance Bancorp. This was down 36% this morning before trading halted on this banking company. Here you have Signature Bank, which they also halted trading. Before trading was halted, it was down 23%. So these banks, without knowing and digging in, we know they're connected to each other, right? Because all their prices are falling exactly the same way. And here's PacWest Bank Corp. Again, another bank company whose shares have been halted. So we can tell they are all connected. Now, it may just be contained or it may not, right? One of the sayings is there's never one cockroach, right? Because if you think about it, there's never one cockroach. But is this going to be contained to call it, West Coast banks, California banks, banks that had a lot of dealing with basically Silicon Valley Bank and banking? We don't know yet. Now, the other major banks like Bank of America, and I can show you that right here on the price chart. So here's BAC here. It's down. It looks horrible. It is below its pre-COVID high, so that does not. But as far as today, It's still trading. It's only down 0.5%. It's not down 20, 30, 40, 50, 60% like those other banks were if they weren't halted. So it's not really moving over to kind of these major banks. In fact, JP Morgan is up 1.7% today as we talk about it. But again, look at where it is relative to the pre-COVID high. It is above it, so that's a good thing, but not looking that good. The other thing, and if you've been watching my videos for a while, I've talked about Blackstone and how even last week I talked about how they defaulted on a $500 million. It was actually more, $500 million loan. They just didn't pay it. So it's moving, right? Blackstone defaults. It was almost 600 million. They default. Now you have Silicon Valley Bank. You have these other companies that are starting to behave in a way that doesn't instill confidence in people. And so we're seeing this right now. Okay. So let's just talk about the takeaway and what to do. First thing, what you own is the strategy that that manages your portfolio. People often talk about, I own XYZ. No, you own the strategy that owns XYZ. The strategy is what you own, right? And so when you have a portfolio, you want a strategy that manages that portfolio that almost doesn't care whether the market goes up or down or sideways, but has a way to respond and adapt to what is going on. I love the Darwin quote, right? Darwin always talked about the animal that survives wasn't the fastest or the strongest. It was the one that knew how to adapt. And so whatever strategy you have, by the way, a 60-40 does not adapt. A 70-30 does not adapt. An 80-20 does not adapt. Those are not adapting portfolios. They are fixed. They're actually business models that were designed in 1952. But you want a strategy that adapts to what is going on. And so what we have right now is a market that is, at least with regional banks, is saying something's really wrong. I talked about last week how Blackstone was defaulting. They made a decision to just default on a almost $600 million loan. Like, yeah, okay, it was a business decision. But things are starting to move throughout, the economy and the market. And so you want an approach, right? You want a strategy that can adapt to what is happening right now. Thanks everybody for being in my world. I appreciate you watching my videos. Please like, subscribe, leave a comment. All of those things make a difference. It helps the algorithm and YouTube get the video out to other people who may not know about this. And let me know where you think I got it right, where you think I got it wrong. And if you are finding yourself that having to manage my own money is a bit of a burden, and maybe you started managing your own money because you had the big box advisor, and you're like, well, I don't even get why they have me in that 60-40 or that 70-30. And so you took it over. But then you kind of ended up in this like pick of the month newsletter world hell of like 10 or 15 newsletters helping you find the next Google of Europe or Facebook of India. And there's this burden now you having to check into the market and having to listen to the news. It does not have to be that way. We solve that problem. We fix that problem at Fearless Wealth. And so if you're curious about how to have a strategy that is adapting to what is actually going on, that's what we do. You can just look in the description and get on our calendar. Thank you again for being in my world. I appreciate you, and I will talk to you next week. Okay, bye.